Alright, today is Monday, February 28th, the last day of the month, baby. Lots of short covering at the end. But anyways, this is a recap for the stock market activities today. Folks, I got a good one for you tonight. Let's dive right into it. In focus. How about we start with the wall of worry, specifically Russia and the Fed, and then we're going to talk about the tape, interesting action today. And lastly, how about a message for Snake Bill Ackman? We start with the wall of worry, specifically Russia, because it is the most active item on the wall of worry. And today we got more sanctions, perhaps the most severe sanctions so far, against the Russian central bank, banning all transactions, with a few exceptions, of course, which we're going to talk about in a minute. But this is severe punishment for the Russian central bank. And of course, the Ruskies woke up a little poorer today because the ruble crashed once again. And of course, this will push inflation significantly higher in Russia, and therefore, this was a major move by the Russian central bank. They doubled interest rates to 20%. A significant move, and of course they're doing this to firm the ruble, to save it from the collapse, but there is one massive drawback, and this is perhaps a little teaser to what's about to happen here in this country, because when you increase interest rates dramatically, like the Russian central bank did, you're gonna have a lot of defaults, and this is the worry right now in the Russian economy. But there are dominoes here, because if the Russian economy goes down, guess what? The global economy is still connected to the Russian economy via the energy trade. And now it is becoming a real possibility that we will see a Russian default, because Russian bonds tumbled as investors braced themselves for the possibility that the latest round of Western sanctions on Russia could push Moscow to default on its debt for the first time since 1998. Wow. But this punishment will not be limited to the Russian economy, as I've said before. Look at this. The Russian economy will lose at least half a percentage point of GDP in 2022, and then a little over 1% in 2023, and again a little over 1% in 2024. But look at the impact in the Eurozone, the UK, the US, the entire world will shave off GDP points. What does that mean? We're getting closer and closer, if not already in stagflation, where GDP starts to go down, the pace of economic activity starts to slow down, but inflation continues to rise higher. And by the way, we have yet to see the nuclear bomb, not the actual one, but the economic one. What happens if we have sanctions against Russian exports? What happens if the Russians start to cut the supply of gas, oil and gas, to European economies? Look at the dependency here. Germany, Poland, Finland, all of these companies rely tremendously on Russian oil and gas. And by the way, here's the hypocrisy. They're virtue signaling, the Europeans of course. We have to punish the Russians, all these crimes against humanity, yada, yada, yada. Yet with the same mouth, they're not sanctioning Russian exports, specifically oil and gas, because they know if they do that, their economies will cripple down immediately. And here it is, the UK still importing Russian gas and oil. So while they say stop the war in Ukraine, the Russians are committing crimes, the world needs to wake up, yet you're funding the Russian war machine to commit all of these atrocities that you're talking about. You're still buying oil. You're still funding them. Here's another genius move by the EU. EU energy ministers likely to decide on Monday to connect Ukraine and Moldova to EU electricity network to make them independent of Russia. Give me all the face palms of the world, because Ukraine is a huge, vast country. If you're going to connect it to the electricity network of the EU, who's going to power this network? The answer is Russian oil and gas. So again, you circle around like a clown, but the end result is still pumping money into the coffers of Russia. There is no way to escape it here, folks. This continent is still dependent on Russian oil and gas. There is no way around it. And today in the morning, the Russian central bank decided to block orders to sell Russian securities. What does that mean? All of these European and international companies that wanted to divest from Russian securities and assets, they were not able to do that entirely. You saw BP down. BP wanted to divest the Russian assets. BP was down big today. All of the names that are involved with the Russian trade were down big. Philip Morris, PepsiCo, McDonald's, Aerojet. All of these companies got clobbered today because it's not going to be that easy. And letting go of Russian assets will have financial ramifications for these companies. So folks, we're seeing the ripple impacts starting to form. On top of that, in the morning, there was a peculiar event of Toyota getting hit with a cyber attack. Now, a reminder, Japan started sanctioning Russia as of late, recently, I believe over the weekend. Was that a retaliation against Japan? Who knows? But here we go, we're escalating by the day. There are peace talks going on, but we're escalating economically speaking by the day. And rest assured, Goldman Sachs says, we got your back. We'll tell you how to benefit and profit from the tragedy. Hint, buy defense stocks. What else on the wall of worry? How about the hawk? The Fed, not so hawkish as of late. The doves are coming back. For example, Atlanta Fed President Raphael Bostic, aka The Game, who was in the hawkish camp early on. He was talking about the necessity of normalizing the monetary policy and raising interest rates by 50 basis points. He and Bullard were the first to bring up the 50 basis point increase in March. Now, Bostic is backpedaling and saying perhaps we'll settle to 25 basis points. He's not closing the door entirely to 50 basis points, but the retraction is important. It tells you where the sentiment is in the Fed. If Bostic wants to do 25 basis points, I bet Williams and Daly want no interest rate hikes due to quote-unquote uncertainty. Of course, the Fed will not let any emergency go to waste. Gotta prop up those stocks higher. Speaking of those stocks, the tape today was mixed and confusing. We saw bull traps, we saw bear traps, pies in the face, all over the place. For example, in the morning, when we look at the indicators, the Russia-Ukraine conflict indicators, palladium was higher, that is bearish for the stock market. Wheat was higher, gold was higher, the RSX was down. So these four were in the bearish camp, meaning stocks will not go up. On the other hand, and I tweeted about this in the morning, crude oil Brent took a nice dive to the downside off the highs, still closed in the green, but way off the highs. This was a point in the bullish camp. Point number 2 was the VIX. The VIX got rejected from 33 right off the gate. So the bulls had points to play with here in the morning to buy the dip immediately as a trade, of course, an intra-day trade. I'm not a day trader, by the way, but in this kind of market, you gotta be always be closing. You make a little bit of profit, you get out immediately because they're gonna flush you down, they're gonna push you higher, you're gonna eat pies in the face multiple times. And therefore, another strategy you can use is stay on the sidelines. You don't have to trade every single day. If the market is not presenting you with a nice, clear opportunity, you're better off staying on the sidelines. Another important point for the bulls in the morning was the fact that Tesla and BTC Bitcoin were trading higher. Now, Tesla was trading higher due to the activities by the so-called Tesla whale and other important events that happened in the market today. We'll talk about that in the options market coverage and the heat map analysis. But when it comes to Bitcoin, there was another important tailwind that connects to the Russia-Ukraine conflict. Russia banned the transfer of currency abroad, overseas, because they're afraid that the value of the ruble is going to crash even more. In doing so, they opened the door for Russians to buy cryptos, in this case Bitcoin, and therefore you can circumvent all of these restrictions. So this is a massive tailwind for Bitcoin. Is it going to last for too long? Who knows? But with all of these sanctions, and the public is starting to become aware of how centralized the banking system is, the idea of cryptos and Bitcoin is starting to become even more attractive. So we'll see if that is sustainable or not. But for now, it was a massive move to the upside in Bitcoin. And Bitcoin, so far, has been a leading indicator for the action in stocks. Now, as the day progressed, we started to see some bearish signals. For example, Brent was off the lows, the VIX started to rally, and then equities took a leg down. And the Qs in this case, the NASDAQ, pretty much was acting as if 334, the line in the sand, is not a reliable support, at least for now. It went down after that massive pop higher, retest 334, indicating that perhaps it is not a solid support. Indeed, it breached below that support. What do you know, by the end of the day, a lot of short covering activities happened, and the Qs managed to close and recapture 343 as support. So pies all over the place. This is one of those days that you're better off staying on the sidelines. We'll talk more in the charts analysis and see where the market is going for now by doing the technicals and reading the psychology of the charts in the charts analysis. Now let's cover some bullish calls, this time around from JP Morgan. The criminals at JP Morgan, they say selling stocks now carries too much risk. This is the same JP Morgan, by the way, where Marko Kalanovic has been saying buy the dip, buy the dip, buy the dip since December, by the way. And so far it has been catch a falling knife, catch a falling knife, catch a falling knife. And as recently as February 8th, the JP Morgan strategists said that they see fire sign that it's time to buy stocks. You know exactly what happened since then. But we have some reliable technical indicators that perhaps the market is forming some bullish formations, indicating that we will see a rally that will go on at least all the way till the FOMC meeting in March. For example, if you look at the S&P 500 in black and then the RSI in blue, as you can see, the S&P 500 made lower lows, yet the RSI made higher lows. Last time around, we saw this kind of signal was back during the Thing crash in 2020, when the S&P 500 was forming lower lows, yet the RSI was forming higher lows. What do you know? Since that time, the market recovered and didn't look back at all. So could it be that what we're seeing right now is a bottoming formation? We'll see. Another important indicator for the bulls is the fact that 70% of the NASDAQ is trading below the 200 days moving average. Now, this is a contrarian indicator because when you have 70% of the NASDAQ trading below the 200 days moving average, we're talking about a crash here. We're talking about the end of the bull market or the bull run, just like we saw back in the implosion of the dot-com bubble. In the meantime, for the short run, this could be a contrarian indicator that some of these oversold names could catch massive bear market rallies. So again, this is the contrast between the short-term prospect versus the long run. This is an indicator where market bulls should look at and say, honey, grab another diaper. I'm going to need it, because it tells us that the market is crashing. It's just a matter of time before the entirety of these indices come down crashing. In the short run, it opens the opportunity for very profitable trades. And now let's talk about the bearish sentiment and positioning in the stock market. In this case, here's the headline from the Wall Street Journal that says, bearish bets against market are surging. Investors are loading up their bets against a number of big tech stocks, positioning for a reversal. What are they talking about? Here's what they're talking about. Jordan Kahn, Chief Investor Officer at ACM Funds, said his firm has been trimming its position in stocks in one of its strategies while adding to short positions against exchange-traded funds, ETFs, that track the broad market. Mr. Kahn said he grew concerned near the end of 2020 when he saw that individual stocks were selling off, while the larger stocks kept major indices afloat. Now, remember what Jeremy Grantham said. Bubbles don't end all at once. A massive crash. They end in increments. They hit the high mania stocks first, the RKKs, the SPACs, the garbage names, the meme stocks, and then they move to the mid caps, the best performers, they get shot, and then little by little, they start shooting at the big guys, the Apples, the Microsofts, the Googles of the world. Matter of fact, Facebook already got shot. This is one of the major big caps, and this is exactly what we saw back in 2000 when the dot-com bubble crashed. The high mania names, the Pets.com, the Globe.com, those already crashed way ahead of time. Then came the Qualcomms, the Yahoos, the AOL, and then little by little, they started shooting at Cisco and Microsoft. So this is exactly what's going to happen here. At least, this is the bear theory. Continuing, that is kind of a red flag for us, he said. We think that most likely scenario is that those big stocks that haven't had a big correction yet will probably at some point play catch up to the downside. Uh-oh. Investors are loading up their bets against a number of big tech stocks that led the way higher in recent years, positioning for a reversal. Investors added $1.3 billion to their short positions against Tesla over 30 days through Friday, and almost $844 million to their bets against NVIDIA, according to S3 Partners. They have been trimming their bets, by contrast, against Bank of America, Apple, and Texas Instruments. I disagree with Apple. I think Apple is going to fall really soon. It is already starting to break certain technical levels and technical patterns, most importantly. NVIDIA shares have fallen 20% in 2022. But they're up 63% in 2021. Tesla's down 22% this year, but is up 15% from a year ago. Both stocks have skyrocketed since the end of 2019. The message is, It is just a matter of time before they start shooting the big guys. What's keeping us afloat right now is the fact that the Fed is pedaling back their hawkish stance. We're moving away from 50 basis points to 25 basis points. But it's just a matter of time, folks, because inflation continues to move higher. So what do you do as an investor here with all of these worries and volatility that's going on here? You gotta look for consistent performers, not the names that pop for one day or 1 week and then they fade right away, as we're seeing in these growth high multiple stocks. Where is the consistency of performance right now, at least so far this year? The answer is value. Matter of fact, this is the best relative performance for the S&P 500 value versus the S&P 500 growth since 2001. I wonder what happened back then. Oh yeah, the bear market for the NASDAQ and tech and the beginning of the bull market for value. Matter of fact, Berkshire Hathaway outperformed the NASDAQ tremendously from that point on all the way till the 08-09 crash. Now, let's segue and talk about Snake Bill Ackman, because he came out today and suggested that the Biden administration send U.S. troops to Ukraine.
What a stupid son of a bitch.
And set a quote-unquote real red line. And I say really, Billy Boy, because the majority of the American public is empathetic to the tragic events in Ukraine. But the majority of Americans overwhelmingly don't want to engage in another war. No troops in the ground, no nuclear war. The overwhelming majority of Americans say that. But of course, the oligarchy doesn't matter sending some poor and middle-class folks, sending other people's kids to die in Ukraine, calling it a real red line. Why? Why is it a real red line, William Ackman? Are you going to say due to humanity? There are human suffering? Where was the real red line when millions of people died and got massacred in Iraq, Libya, Syria, Yemen, Myanmar, Afghanistan, where, by the way, your boy Joe Biden committed a war crime by bombing 7 kids. But hey, that was a mistake. We did not mean it, so we have to move on. Where's the outrage for all of these massacres and tragedies that happened in Iraq and all of these countries? But now we have to care about Ukraine? All of this outrage about Ukraine? I wonder why. Why do we have to care when Ukrainians are suffering tragedy, but not Iraqis or Yemenis, Syrians? Why? I wonder why. Where is the outrage, by the way, when you have a country that has camps? I cannot say what kind of camps because the robot police would go, what do you say? But you know what kind of camps. Millions of people are still in these camps. No sanctions, no outrage, not a tear shed. We continue to do business with that country, pouring billions of dollars. Corporate America, Apple, Nike, Yum Brands, Starbucks, Tesla, McDonald's, pouring billions of dollars in that particular country when we have a human tragedy happening right as we speak. Where is the outrage, Mr. Ackman? All of these consumers on social media with the outrage, the fake outrage over Ukraine, yet they're still consuming Chinese products. Why is it a red line once again, Mr. Ackman? Democracy. Is that what you said? Democracy? Well, Ukraine was never a democracy. It was one of the most corrupt countries on earth. NATO did not want it because it was so corrupt and had many other problems. They should have included it in NATO way before. The EU today, they're still not including Ukraine. Why? Because they know it was a corrupt country and it is a liability to their financials. All of this virtue signaling and outrage, but they don't want to put their money where their mouth is. They want Americans to fix their problems once again. We have to pay the tab and, oh, by the way, shed blood, tear, and sweat to defend Europe and solve their problems. So again, why is it a red line? Is it because of peace? Is that what you said? Peace? Well, these countries, Russia, Ukraine, been fighting each other for a long time, for years, with a lot of ethnic problems that we talked about yesterday. They've been accusing each other of atrocities. These ethnic problems have been going on for years. All of a sudden, we're going to solve them right now, like we did in Iraq with the Sunnis and Shia, for example. But yet again, the oligarchy look at all of these tragedies as an opportunity to make more money. The defense contractors are making money right now. The oil and gas companies are licking their chops, waiting to score these gas deals with European countries instead of Russia. Mr. Ackman, we have problems here at home. Inflation is crippling the poor and middle class of this country. We have a hunger crisis. We have a homelessness crisis. We have an infrastructure that is crumbling. We have over $30 trillion in debt. We have a dying American dream for the millennials and the Gen Zers. Attaining home ownership is impossible these days. So, Mr. Ackman, I say, if you really want to defend Ukraine, and it's a red line for you, lace up your boots, suit up, and go ahead and volunteer with the Ukrainian Defense Forces because they're looking for volunteers. Put your money where your mouth is, or pretty please, shut the up. And with that friendly, lovely note out of the way, let's move on and cover the market information today. We start with the performance of indices, and here we go. The Dow Industrial Average today was down 166.15 points, or a decline of almost half a percentage point. The NASDAQ was the outperformer, closing in the green by 56.77 points, or a gain of 0.41%. The S&P 500 down by 10.71 points, or a decline of 0.24%. What about the sector performance today? Leading the pack at number 1, capturing the gold medal, energy. Number 2 for the silver, utilities. Number 3 for the bronze, industrials, aka defense contractors. Stick around for the heat map analysis. Yet the laggards of the day led by REITs, financials, and consumer defensives. What about the advance to decline ratios? NYSE 82% advancing versus 15% declining. NASDAQ 71% advancing versus 25% declining. The breadth is excellent today for both the NYSE and the NASDAQ. The problem is when you see exaggerated ratios such as 82% advancing, you're gonna get a pullback, at least in the pre-market. What about commodities? What's going on here? It was a massive pop initially in the morning for both the Brent and the WTI, but Brent closed pretty much on the flat line while the WTI exploded higher, closing with gains of 4.5% almost. So you're gonna see these gasoline prices moving higher. Matter of fact, gasoline futures also gained a little over 2% today. Heating oil, gains of almost 4.5%. Yet natural gas was down a little over 1.5%. And by the way, Goldman Sachs says that demand destruction is the only thing that can restrain oil from continuing to surge higher. This is an important statement, folks. What do they mean by demand destruction? Either you're going to have an event such as the thing, for example, another variant that's going to lock us up, or an aggressive stance by the monetary policy, increasing interest rates out of whack to control prices and destroy the demand in the economy. Folks, there is no escape here. They're going to push these crude oil prices higher and higher and higher. The administration is stuck between a rock and a hard place. The only options that they have right now is to use the strategic reserve once again, but we know from the past that this actually fired back. It reduced the supplies that we have. It was a temporary band-aid. What do you know? Crude oil prices continued to surge higher. The tailwinds, even absent of the Russia-Ukraine war, the tailwinds are still intact and they remain extremely strong. I have no doubt in my mind, if the Fed doesn't act aggressively and immediately, by the summer, we will see the WTI at $120 a barrel. What does that mean? You're going to see $8 to $9 a gallon here in California in certain places. We haven't seen the end of this inflation crisis yet. And by the way, look at the backwardation here for the Brent, not the WTI. When we look at the 2 to 3 month spread, for example, it is at the highest level going back to 3 decades. What does that mean? Market participants, in this case futures traders, are expecting a massive move higher in Brent, at least in the short run. But then we will see a cool down. What is the shock event, you might ask? A severe escalation of the war, but most importantly, sanctions against Russian exports of oil and gas. Back to the futures, what about softs? We have a down day for cocoa, big time, almost 4% in the downside. Likewise, coffee was down a little over 2%, and lumber closing soft, losing half a percentage point. Likewise, cotton was down modestly, pretty much on the flat line. The gainer today was OJ, closing the day with gains of over 4%. Meanwhile, sugar closed the day with modest gains, barely in the green. What about metals? We have gold and we have palladium. These are two indicators in the Russia-Ukraine conflict. Both of them are in the green, favoring the bearish camp for the market. Gold was up, silver up, palladium up big, almost 5.5%. Likewise, copper, it's a little soft, but it managed to close in the green. The loser of the day was platinum, losing half a percentage point today. What about meats? Modest losses for both live cattle and lean hogs futures. On the other hand, feeder cattle futures were down big, over 1.5% today. What about grains? What you see in the screen right now is not accurate because the news session already started when I took this shot, but we're watching wheat, and here is wheat today. As you can see, London wheat was down. Why is London wheat down? The reason is this is where the Ukrainian and Russian exports are traded. And therefore, with the lack of supply, the restraints due to the conflict, London wheat is down. But look at American wheat. U.S. wheat up big, almost 9% gains today. And this will continue to go on and on and on. The tailwinds for wheat are absolutely strong and intact. Any dip in wheat is worthy of buying right now. Likewise, we have gains across the board. Soybeans, soybean oil, soybean meal, corn, rough rice, oats, all up big. This is the trade right now, folks. Grains is the place to be. How do you play grain stocks? Stick around for tomorrow's video. Moving on to the big casino, the options market. What's going on here? The hottest table by far today was the souffle Tesla. And boy, we saw insane, and I mean insane, call options buying. And this is due to the so-called Tesla whale. Almost 900,000 contracts traded for Tesla today. About 58% of those were calls. And look at this. These are the weekly options for Tesla. The volume traded for the 900 calls, way out of the money, exceeded 62,000 contracts. What does that mean? We have a large type trader who's pumping and dumping. They open these contracts and they dump them right the same day, or as we by now familiar with, Tesla whale dumps at around Wednesday, Thursday. But as of late, he's been dumping a little sooner than that. And where is the SEC, you might ask? The SEC remains in a coma. Here it is at number 2, Apple. Look at the volume, down big. From over 1 million, now we're back to almost 800,000 contracts. About 56% of those were calls. At number 3, AMD, with a little over 500,000 contracts traded today. About 71% of those were calls. What about the unusual activities that we got today in the casino? We start with the ticker TDOC, Teladoc. Moving higher today. One of these Cathy Wood names, oversold, overbeaten, perhaps an opportunity to play a bear market rally. At least somebody thinks that. They bought the $80 calls for the expiration date, March 4th, meaning this Friday, with expectations that the name could pop higher an additional 5% or so by then. They paid about $1.45 a piece to enter this trade. All in all, spending about $3 million. What about the trade for the ticker TPX? This is for Tempur Sealy. If you're looking for money under the mattress, you might find it here because somebody's buying calls. The name is off the highs, but it is one of the top performers at least last year. Somebody's betting that we will see buying of the dip and the name will resume rallying higher. In this case, they bought the 35 calls for the expiration date, March 18th, with the expectations that the name could pop higher by more than 6% by then. They paid about 70 cents a piece to enter this trade, all in all spending about $900,000. What about the trade for the ticker SPY for the S&P 500? They're buying puts here, the 395 puts for the expiration date March 14th, with the expectations that the SPY could drop down by more than 9.5% by then. They paid about $1.30 a piece to enter this trade, all in all spending about $1.4 million. What about the trade for the ticker TSLA, Tesla? Somebody's fading the rip here big time. Perhaps Tesla whale himself here, pumping and dumping, because somebody bought the 820 puts for the expiration date this Friday, March 4th, with the expectations the TSLA would drop down by more than 6% by then. They paid about $9 a piece to enter this trade, all in all spending about $10 million. What about the trade for the ticker RSX? This is the Russian ETF. It is in free fall, of course. At some point, we're going to have an excellent trade here, a rebound rally higher, but it is too risky for now. You don't even want to touch it because it could get delisted. We could see more pain to come for the Russian stock market. The only hope for now is a peace deal, and I don't see that possible at all. All I see on TV right now is more and more escalation. So somebody's buying the $10 puts on the RSX with expiration date this Friday, expecting another drop of about 8% or more by then. They paid about $1 a piece to enter this trade. All in all, spending about $900,000. What about the trade for the ticker ARKKKKK for Tesla witch Cathy Wood? They're fading the rip once again. I mean, what rip, right? But anyways, they're buying the 66 puts for the expiration date April 14th, with the expectations that RKKKK could drop down by more than 6% by then. They paid about $4 a piece to enter this trade, all in all spending about $2.5 million. And lastly, at the bottom of the table, what about the ticker HZNP for Horizon Therapeutics? One of the top performers as of late, but somebody's fading the rip here by buying the 85 puts for the expiration date March 18th, with the expectations that the name could drop down by more than 7% by then. They paid about $3 a piece to enter this trade, all in all spending about $1.8 million. Moving on to the heat map analysis, what do we have here? Let's talk about the underperformers first. The underperformers were pretty much tied up with the Russian sanctions. For example, financials were down big. Morgan Stanley, Goldman Sachs, JP Morgan, all down big. And then you have the airlines, because we're banning Russian airplanes from flying over European airspace. The Russians are banning European planes from flying over their territory. So we have the tit for tat. What does that mean? It means more spending on jet fuel. This is not good for airlines. Likewise, BP, Shell, all of these European oil producers were down because they're divesting from their Russian assets. Meaning, how about we dump the entire business out of the window? I mean, if you're BP and you're divesting from your Russian assets, then what do you have left? So BP was down big. And then we have in consumer defensives, I shared with you the names with the highest exposure to the Russian market. Among them, Philip Morris, PepsiCo, Mohawk, McDonald's, and the list goes on. But look at this. Philip Morris is down big, and by the way, I had a trade on Philip Morris. I hope that some of you followed me in this trade. Let's go back and review this one. Number one, I shorted the name that was popping higher on the Russia-Ukraine tensions. This name is the ticker PM Philip Morris. As you can see from the weekly chart, we're getting way overextended. It doesn't mean that the stock has to fall right away, but the risk versus reward says we are due for a pullback. And here it is. Here's the update. And as you can see, the trade is working accordingly. And I continue to hold on these puts for Philip Morris. But as you can see, PepsiCo was down. McDonald's was down. Any name with exposure to the Russian economy was down big today. A lot of these diagnostics and pharmaceuticals were also down big due to the ties with the Russian economy. Another concerning underperformer is TSM Taiwan. Why are they continuing to dump Taiwan? To me, this is alarming. This says that perhaps Taiwan is next. It also could mean that we could see a disruption of palladium exports from Russia. Now, let's talk about the overperformers. Obviously, oil and gas, Chevron. I continue to like Chevron at this stage over Exxon. But we also have the defense contractors up big. Thank you to the warmongers over at TV and social media. Oh, the war is going to be good for these defense manufacturers. Germany alone is upping defense spending with over $20 billion. All of that money is going to go in the pockets of Raytheon, Lockheed, Northrop, Boeing, General Dynamics. You gotta be in these names. If these criminals are going to make money off war and tragedy, then the little guy should get a taste, don't you think? Some of the top performers today, and this is a theme, watch out here. As we see oil prices surging higher, we're seeing the so-called green energy also surging higher. In this case, EV manufacturers, Tesla, Rivian, Lucid, NIO, Xpeng, Li, all moving higher. Is this theme sustainable or not? That remains to be seen, because solar names were up too, big time. For example, Solar Edge was up over almost, I should say, 15%. What is the market saying here? The market is saying perhaps we will see another package of so-called renewable energy spending, because at this stage, even if you're bullish on these names, think about it. If oil prices surge higher, there is no supply of EVs. The supply of solar is getting scarce, and it's getting way more expensive than before, by the way, due to shortages and the supply chain disaster. And these material prices continue to move higher and higher and higher. So I think the market is looking for a deal, a government deal, spending deal. This is not a sustainable way to initiate a rally. Here's another outperformer today. Fertilizer stocks. I've been telling you over and over and over again, folks, since last year, there's a lot of money in shit. Stick with Mosaic, stick with Nutrien, stick with FMC, stick with Corteva, stick with Deere, stick with ADM. All of these are good names that will continue to appreciate in this inflationary environment. Moving on to the heat map for the ETFs. As you can see, muted activities across the board. The significant movers to the upside were the VIX proxies, the TLT bonds moved higher, and oil. The XOP up big, XLE, OIH, USO, all moving higher. The laggards, REITs, financials, materials, technology, and by the way, international markets, specifically European markets. I say avoid Europe right now. If Russians decide to cut the supply of oil and gas, you will see these indices, the DAX specifically, Germany, collapsing. We're talking down days of over 5%, just like we're seeing right now with the RSX, Russia. I continue to be bullish where? EWZ, Latin America, Colombia, Chile, Peru. These are the international markets that are working right now. They're isolated from all of these tragedies. and the worst of inflation is already behind them. Moving on to the charts analysis, and we start with SPY's chart, the S&P 500 30 minutes chart. What do we see here? It is a consolidation day. We went higher all the way, knocking at the door of 438 as resistance. That failed right away, and then danced around the support at around 434, not touching the line in the sand, by the way, at around 430. So this is the good news for SPY bulls. Now, we have certain overbought conditions on the RSI. There are three ways you can work these overbought conditions on the 30 to the hourly charts. Number one, this is the bullish way, consolidation. Number two, this is also bullish, but not as bullish as consolidation, which is a pullback. You pull back, you correct the overbought conditions, and you march higher again. And the bearish way to correct all of that is a gap and crap. What did we have today? The answer is consolidation. So this is 1 point in the camp of bulls. The bears are not going to start to score until and unless the SPY closes the day below 430, preferably by a lot, perhaps reaching the support at 422, but at that point it's going to be obvious. So a daily closing below 430 will remove the bull flag pattern, the consolidation that you see right now, and the bears will get excited to short once again. Here's a daily chart for the SPY's futures, the S&P 500. Look at this, a pullback to the mid-body of yesterday's candle and then closing pretty much at the highs of the day, not making it above 4,384.5, but all in all, this was a bullish day. This was a score for the bulls. The volume is moving higher, above average. On the buying side, the momentum indicators are curling higher. So far, we haven't seen the end of the so-called bear market rally, at least not yet. We're waiting for a reversal signal. We can see intraday reversal signals, but at the end of the day, you gotta find daily reversal signals. We have yet to have one on the SPY's chart. What is the reversal signal, you might ask? The answer is closing the day below 4,232. Now, I'm not gonna play this game right now, but other chartists on YouTube and otherwise could play the scenario of an ABC pattern to the downside. That's not going to be evident until and unless you breach below 4,232. So what is the point of playing these scenarios right now? Here's a chart for the Qs, the NASDAQ 30 minutes chart. Just like we saw with SPY, today was a gap down, but immediately dip buyers showed up. And what do you know? There was a failure in the rally, a halt. And we went down to retest and dance around 343 over and over and over again, breaching that line by a little bit, creating some bear traps. As you can see from a 3 minutes perspective, for example, there was a head and shoulder formation. It played out for a little bit, but then what do you know? The rescue at the end of the day was initiated and 443 was recaptured as support. Now, when we look at the RSI for the 30 minutes chart, we are working the overbought conditions via consolidation. This is a bullish point, not a bearish one. We're now eyeing 352 as resistance and 343 remains support. The bearish camp should not get excited until and unless the Qs closes the day below 334, or we have a reliable reversal signal. From a daily perspective, folks, not an intraday one. Unless you're trading intraday, these reversal signals midday mean nothing at all. Here's a daily chart for the continuous contract for the NASDAQ. As you can see, the chart went down to retest the lows of yesterday's candle, and then reversed and closed at the highs of the day. The question is this bullish or bearish? The answer is, it is bullish. Likewise, 14,000 was recaptured once again. The volume remains pretty much at average on the buying side. The momentum indicators are curling higher. The MACD is showing green impressions on the histogram, at least one. We have yet to see the confirmation. So all in all, the bulls, I would say, have a 60% advantage in this chart right now over the bears. The bears will come back if we see a failure, a pullback, and a breach of 13,600. And here's a 30 minutes chart for the IWM small caps. The rally goes on. It went all the way to retest 204.5 as resistance, and it pulled back from that point on. Was that a rejection? Of course not. The IWM could give it another shot, but again, it remains closer to overbought territory. So a pop above 204.5 and a failure to close above that number would be a reversal signal because the RSI is overbought for now. So the risk versus reward says if you bought the IWM at the bottom, which we spotted in this channel, by the way, last Thursday, you might want to take some profits here. You don't want to be too greedy. What about the DXY daily chart? Pulling back from the support, now resistance at around 97. The ruble was down big today, but yet the dollar closed pretty much at the lows of the day. The ruble has not a lot of impact on the dollar, as we see with the euro and the sterling, the Australian dollar. But again, these massive moves, as we've seen with the Turkish lira, by the way, they have an impact on the dollar because we have a rush to exit one currency in favor of the US dollar. But the dollar closed at the lows of the day. Is this a signal that perhaps we're reaching the bottom in the ruble? That remains to be seen. The dollar is getting a little overextended in the RSI, but it is not yet at overbought territory. What about gold? Look at that. Every dip is worthy of buying right now in gold. The problem is the technical is a little overextended. They're overbought for now from a daily chart perspective. The chart is working that overbought condition via consolidating. This is a good development for gold. But again, I would like to see a pullback, perhaps to 1,880. That will work out all of these overbought conditions in the charts. There will be a reliable dip to buy if the conflict continues to go on. Here's a daily chart for the 10-year yield, a drop losing the support of 194. What does that mean? Every time we see a drop in the 10-year yield, it means more escalation on the Russia-Ukraine front, which is not necessarily good for stocks, but we have another item in play here, which is the Fed. The moment Boystick came out and talked about maybe not 50, maybe 25, we saw a massive leg down in the 10-year yield. Now, listen to this. This is important. When the 10-year yield goes down due to the Russia-Ukraine conflict, equities also go down. But when the 10-year yield goes down because the Fed is becoming a little more dovish, equities go higher. So you have to watch the chart in real time, the 10-year versus equities, and you come up with a conclusion right away that perhaps the market is rallying based on the dovish optimism. Here's the TLT's chart, weekly chart, a pop higher. Now we're retesting 140 as resistance, and look at that, the RSI is curling higher. So is the MACD, reversing the divergences, the negative divergences. The TLT continues to move higher, capturing 140 as support. My assumption is that we will see the NASDAQ also moving higher, in a relief rally, of course. Here's the VIX 4-hour chart. Despite all the fear, the pop in crude oil, the futures were down big, more sanctions. The VIX failed to pop today. Matter of fact, it got rejected at around 33. This was a good sign for market bulls, and it remains a good sign. The problem is, look at the MACD indicator. The VIX, for all we know, could pop higher again and recapture 33 easily, and then we see a reversal in the MACD. So the bulls are not out of the woods yet, and therefore I say, maybe you want to stay in the sidelines right now, because pulling the trigger and buying calls, for example, what happens if the VIX decides to pop higher, recapturing 33? Now you're getting a pie in the face. Why not wait till the VIX breaches below the last run's low, maybe below 27, for example, and then you have a confirmation that indeed volatility is weakening and we're seeing less hedging in the stock market, meaning the SPY moves higher. For now, the bulls are not out of the woods, at least looking at this chart, and the bears are licking their chops, waiting for a pop above 33. Here's a 4-hour chart for the VXN, the VIX for the NASDAQ. We have a confirmation in the MACD for the weakness. We're seeing red impressions on the histogram, but we're not seeing a divergence between the white and the blue line in the MACD, which is the average. What does that mean? It means at any moment now, the VXN could pop higher and we see a reversal right away in the MACD indicator. A divergence, a widening of the gap between the white and blue lines will confirm to the bulls, NASDAQ bulls, the VXN is weakening and you have the green light of buying the NASDAQ. Here's the problem with the action that we got today. Weakness in the VXN, perhaps prompting the modest rally in the NASDAQ, but let's remove all of these markings, and here it is. The VXN is making higher lows and higher highs unless this pattern is breached, meaning making lower highs, but preferably lower lows, you don't have a confirmation yet that you should buy the dip in the NASDAQ. Here's a daily chart for Apple, a move higher, yet not touching the upper edge of the channel and far below 172.4. I'd avoid it for now. It appears that we're moving away from Apple and perhaps buying the dip in the oversold names. I'd like to do that rather than buying Apple at this point. Here's an hourly chart for Tesla, the souffle. Those of you who bought calls last week, you did not eat a pie in the face. The bull flag played out. Thank you to Tesla Whale, by the way. And then we have another bull flag. The problem is, unlike last week's bull flag, This bull flag happens hand in hand with overextended readings in the RSI and MACD, meaning this bull flag is more risky than the previous one, meaning there's a high degree of possibility that the bull flag will not work out. Matter of fact, we will see a bull trap where Tesla pulls back starting tomorrow as Tesla whale starts to dump. But let's say the bull flag plays out, and the next target we're looking at is the trend line in yellow. That could be a good point to take profits and start shorting this name on a short-term basis, of course, buying puts, because it is getting overbought on the hourly chart. And by the way, we have Bernstein, who's hiking the price target of Tesla, but still sees 44% downside. What a genius. What about BTC tulips? We talked about the tailwinds for BTC. The Russians are moving away from the ruble. They cannot exchange to dollars right now, not a lot of them at least, but they're moving away from the ruble to Bitcoin, because this is the easiest way to transfer money from Russia right now, in or out of Russia. Similarly with Ukraine, you cannot transfer money easily unless you're using Bitcoin. So we're seeing some tailwind here, an elevation of the volume. The momentum indicators are moving higher, so the bear flag is going to go out of the window for sure now if 42,000 is recaptured as support. And we're getting closer and closer to that. Now, fool me once, shame on me. Fool me twice, shame on me. Fool me a third time, I'm going to beat the living shit out of you. So I'm not going to buy the fact that the break above 42,000 is a buying opportunity unless we see a reliable confirmation. Remember, we got fooled before. BTC retested 42,000, was a confirmation, and then it pulled back. So this time around, we're going to be a little more careful here. Lastly, what about AMC and hourly chart? We have 3 attempts right now at knocking at 21. 1 was met with failure. 2 didn't even make it there. Number 3 now, we're waiting for that one. Could that be the break? Now, if AMC pops higher impulsively so right away, it risks the fact that the RSI, the momentum indicators, will become really overextended and overbought. They risk a third failure at around 21. A better scenario would be consolidation for a little while, working these overbought conditions for now, and then initiating a rally higher to once and for all break above 21, recapture that level of support. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the manufacturing PMI, the manufacturing index, ISM this time around. We have construction spending, and once again, Atlanta Fed President Boystick speaking. With that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.